Hi, my name is Benjamin Alberto Carrillo Barrera, and tonight I'm going to talk about my investment strategy and my fund philosophy. Okay, the description of the fund, we seek to have a conservative approach. Since we want to have the lowest risk, we don't want to do anything crazy. We believe in deep diversification, long-term investments, and growth over time. The investment philosophy is very conservative, as the main objective is to invest in assets in order to hold them for a long period of time. The philosophy is based on asset diversification. In this case, there is $1 billion, and the money will be invested in 15 different companies in the Australian market. The aim is to diversify to mitigate risk and protect investments. We are aware that this philosophy does not seek to outperform the market, but to take advantage of the growth of each asset over time. This philosophy goes hand in hand with the theory of efficient markets, since it is assumed that all available information is immediately reflected in the stock price, and therefore it's impossible to generate excessive returns. By taking a long-term view, no attention is paid to short-term fluctuations. Investment strategy. The strategy chosen for the creation of the portfolio is very well aligned with the philosophy of the fund. This strategy is called buy and hold, and according to Veers from 2022, this strategy is mainly used by passive investors who seek to maintain their assets for a long period of time, ignoring short-term fluctuations and technical indicators. When using this strategy, it's not necessary to rebalance because it seeks to maintain the assets for a long time. So will we have the same assets for a long period of time? We don't need to change stuff. When the investor wants its money, he just tell us and we sell the assets. Some investors are famous for using this strategy, and the most important one is Warren Buffett or Benjamin Graham, who affirms that selling and buying stocks in the short term is the same thing as gambling, and affirms that true investments should be for the long term. Implementing the strategy. The criterion for choosing the 15 companies in which to invest was considering the earnings per share ratio. The companies with the best results on average from 2006 to 2018 were chosen. This parameter was chosen because, according to Brightman from 2017, companies with high EPS are more likely to have a solid foundations of sustained growth. In addition to choosing companies based on earnings per share, it was also considered that they should be from different industries, so we could have a more diversified portfolio. And we don't have like a really high correlation between them, and the changes in some asset wouldn't affect the portfolio. The companies that we chose were ASX with 0.4%, BHP with 12%, Blackmores with 7%, Ansell with 7% as well, Kochlear with 2%, Commonwealth Bank with 13%, CSL Limited with 7%, Flight Center Travel Group with 1%, JB Hi-Fi with 4%, Macquarie Group with 1%, Monadelphous with 1%, Ramsay Healthcare with 18%, Rio Tinto with 1%, Seven Group with 1%, and finally Woolworths Group with 26%. We also use Solver to identify the best combination with the lowest standard deviation, which is the unsystematic risk, and it's like the risk of the stock by itself. So after using the software is how we got the weights for each asset. So here's the percentage of investment for every company, and then this is like the performance of the portfolio. With this exact combination, we get an average of 8.1% of annual returns, with a standard deviation of 12% and a Sharpe ratio of 43%, a beta of 0.7, which is lower than the market, KPM of 2%, Brainerd ratio of 7.1%, and a Jensen alpha of 8.31%. In comparison with the market, the benchmark AES 200, where we get a 1.1 annual return with a market standard deviation of 13.6%, which is higher than the portfolio, and with a negative Sharpe ratio. So in conclusion, it's way better to invest in the portfolio because you get better returns with much less risk. This is a cumulative performance return of the portfolio versus the market. The portfolio is the blue. Some parts they're like highly correlated, mostly of it, because the companies belong to the index, but in other parts the portfolio has a better performance. And here's the annual return. And that's it. Thank you.